Imagine a company 158 years old, older than the telephone, older than the light bulb. A titan that survived the U.S. Civil War, the Great Depression, 2 World Wars. Then in one brutal weekend, it vanished. Not slowly, not with a whimper, but with an earth-shattering bang that sent tremors across the globe. This is the story of Lehman Brothers. On September 15, 2008, it filed for the largest bankruptcy in U.S. history, with over $600 billion in assets. Overnight, 25,000 people lost their jobs, their careers, their future. And as their employees walked out, carrying their lives in cardboard boxes, the world watched in horror as financial markets began to crumble. How did this venerable institution, a cornerstone of Wall Street, collapse so completely, so catastrophically? And what truly happened on the day the money stood still? To understand the fall, we must first understand the empire. Lehman Brothers wasn't just any bank. It was an investment bank, a powerful engine of global finance. For over a century and a half, it had been a key player in everything from commodity trading to mergers and acquisitions, connecting vast sums of money from investors to businesses and governments. Think of it as a superconnector, an indispensable intermediary in the intricate web of global capitalism. But by the early 21st century, Lehman had become a different beast, driven by aggressive ambition and a hunger for risk. Its collapse wasn't just a corporate failure. It was a seismic event that shook the very foundations of trust and stability, proving that no institution, no matter how old or powerful, was too big to fail. Lehman Brothers began humbly in 1850, founded by 3 brothers, Henry, Emmanuel, and Mayer Lehman, as a dry goods store in Montgomery, Alabama. From cotton trading, it evolved, adapting to every economic shift, eventually becoming a pillar of Wall Street. By 1994, a man nicknamed the Gorilla, Richard Fuld Jr., took the helm as CEO. Fuld was a titan, known for his relentless drive and fierce loyalty to the firm. Under his leadership, Lehman shed its conservative image, aggressively transforming into a global investment banking powerhouse. A key move came in 1997 with the acquisition of Aurora Loan Services, significantly deepening Lehman's foray into the mortgage origination business. This decision, seemingly strategic at the time, was a pivotal moment. It thrust Lehman deep into the booming, yet increasingly volatile, housing market, setting the stage for an explosive growth period that would ultimately prove to be its undoing. But how did this aggressive expansion, this pursuit of growth, become a ticking time bomb? The ticking time bomb lay in what Lehman aggressively piled into: subprime mortgages. Imagine a bank that usually lends money to people with solid financial histories. A subprime mortgage, however, is a high-risk loan given to borrowers with poor credit, those less likely to repay. These loans, individually risky, were then bundled together like ingredients in a financial stew, creating complex products called mortgage-backed securities, or MBS. And then, those MBS were chopped up, repackaged, and mixed with other assets in even more convoluted products called collateralized debt obligations, or CDOs. Lehman wasn't just selling these. It was keeping the riskiest, lowest-rated portions for itself, betting big that housing prices would never fall. But that wasn't all. Lehman operated with extremely high leverage. Think of it like this. You borrow vast sums of money to amplify your bets. If you put down $10 and borrow $90 to buy a $100 asset, a small 1% drop in the asset's value means you've lost 10% of your initial capital. Lehman was doing this on an industrial scale, borrowing billions to make colossal bets. This made the firm incredibly vulnerable to even the slightest market downer. And then there was a secret. Lehman used a questionable accounting practice known as Repo 105. This allowed them to temporarily remove tens of billions of dollars in assets from their balance sheet just before reporting periods, making their financial health appear far stronger than it actually was. It was a financial illusion, hiding the true extent of their precarious position. A house of cards built on shaky foundations, amplified by borrowed money, and concealed by accounting tricks. What would happen when the wind inevitably blew? The wind began to blow, gently at first, then with increasing force. By 2006 to 2007, Lehman had aggressively invested, holding a staggering $111 billion in real estate-related assets by the end of 2007. But the U.S. housing. In August 2007, Lehman itself closed BNC Mortgage, its subprime lender, citing poor market conditions. This was a blaring alarm, but the firm pressed on, convinced it could weather the storm. Then came the first major jolt to Wall Street's confidence. In March 2008, Lehman's rival, Bear Stearns, another major investment bank deeply entangled in the mortgage market, teetered on the brink of collapse. The U.S. government stepped in, facilitating a fire sale acquisition by J.P. Morgan Chase. For a moment, the crisis seemed averted, but the message was clear. If Bear Stearns could fall, who was next? The market looked nervously at Lehman, and the cracks widened. In June 2008, Lehman reported a devastating $2.8 billion second-quarter loss, its first since going public. This wasn't just a bad quarter, it was a flashing red light. Yet, Fold and his team continued to project confidence, still holding out hope for a dramatic turnaround. But the market had stopped listening. The once unquestioning lenders, the lifeblood of any investment bank, began to pull back. The question was no longer if, but when the dam would break. The dam broke with terrifying speed. By September 2008, panic was palpable on Wall Street. On September 10th, Lehman announced another catastrophic loss, $3.93 billion for the third quarter, coupled with $5.6 billion in write-downs on its toxic assets. This was the moment of truth. With its balance sheet decimated and confidence evaporated, Lehman was bleeding cash. Over the next desperate weekend, from September 11th to 14th, the fate of Lehman Brothers hung by a thread. High-stakes negotiations took place in New York, involving U.S. Treasury Secretary Henry Paulson, Federal Reserve Chairman Ben Bernanke, and New York Fed President Timothy Geithner. But unlike Bear Stearns months earlier, the U.S. government explicitly refused to bail out Lehman Brothers. The reason? A controversial decision by Paulson and Bernanke, who later admitted to deliberately being vague publicly about whether they could save Lehman, fearing that admitting their lack of tools would cause even greater panic. Without a buyer, without a government lifeline, the 158-year-old institution had no choice. On Monday, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. It wasn't just a bank. It was an economic supernova, exploding with over $600 billion in assets. The largest bankruptcy filing in U.S. history. The decision not to save Lehman became a pivotal moment, a line in the sand that would define the crisis. But what were the true costs of letting this titan fall? The costs were immediate, devastating, and global. The image of thousands of Lehman employees, their faces etched with shock and disbelief, leaving their New York headquarters carrying bankers' boxes, became an enduring symbol of the human toll. These weren't just executives. They were 25,000 staff worldwide, traders, analysts, administrative personnel, whose careers and financial security shattered overnight. Many had dedicated their lives to the firm, only to find themselves suddenly unemployed in a rapidly collapsing job market. While CEO Richard Fuld had pocketed nearly $500 million in compensation between 1993 and 2007, his employees faced an uncertain future, their pensions and savings often tied up in the firm's collapse. The market reaction was brutal. The Dow Jones Industrial Average plunged 4.5% in a single day, the largest drop since 9/11 at the time. Globally, stock markets lost an estimated $10 trillion in value. But perhaps the most terrifying consequence was the breaking of the buck. The Reserve Primary Fund, a prominent money market mutual fund considered a safe haven for everyday savings, saw its share price fall below $1 due to losses on its Lehman holdings. This was unprecedented, and it caused widespread panic, directly threatening the savings and retirement funds of countless ordinary individuals and institutions. The credit markets, the very arteries of the global economy, seized up. Businesses couldn't borrow, couldn't grow, couldn't even make payroll. This credit crunch choked economic activity, leading to widespread job losses, foreclosures on homes, and a severe decline in consumer spending. It ushered in what became known as the Great Recession, a crisis that touched every corner of the world, from small businesses to major hedge funds, leaving a trail of economic destruction and personal hardship. Lehman Brothers wasn't just a bank. It was a domino whose fall triggered a global cascade of ruin. The collapse of Lehman Brothers stands as a stark, chilling monument to the dangers of unchecked ambition, excessive leverage, and opaque financial practices. It was a 158-year-old institution that weathered every storm, only to be brought down by its own reckless bets on a housing market bubble. The decision by the U.S. government not to intervene remains one of the most debated actions of the crisis, a pivotal moment that defined the scale and speed of the ensuing meltdown. For countless individuals, Lehman's fall wasn't just a headline. It was the loss of a job, a home, a lifetime of savings. It revealed the profound interconnectedness of our financial system and the devastating ripple effect when one pillar crumbles. The lessons learned from the day the money stood still are etched into economic history. The necessity of regulation, the perils of hubris, and the enduring fragility of even the most powerful financial empires. But as we reflect on this catastrophic event, a crucial question lingers. Have we truly learned these lessons? Or does the ghost of Lehman Brothers still whisper warnings to a world that may yet face another day when the money stands still? Join us next time as we delve into another chapter of financial catastrophe, exploring the scandals and collapses that shaped our world.